Hello and welcome back to our show. We are back with a brand new episode of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. We are celebrating World Investor Week till October 10th, and since this whole series is dedicated to investors, it's only fair that we mark this Investors Week with a special episode and celebrate it with all our viewers. I am Vishwa, your host for the day, bringing you a conversation with some of the veterans in the area of investing. We all invest for different reasons and goals. However, these days, more and more people are conscious of how their investments affect not only their lives, but also lives of people across the world. This has brought in the concept of responsible investing. So, while you need to be smart with your money, you also need to be responsible with it. The two inherent goals of socially responsible investing are social impact along with financial gain. We'll talk about both these goals. Today, our conversation is all about smart and responsible investing. And to guide us on the same, we have with us three special guests. Our first guest today is Mr. K.S. Rao, Head Investor Education and Distribution Development, Aditya Birla Sun Life Asset Management Company Limited. Mr. Rao is an alumnus of IIM Calcutta. He has spent over 2 decades in the mutual fund industry, and in his current role, he leads his organization's effort towards investor education and distribution development. Welcome, Mr. Rao. We
Thank
are
you.
also joined by Mr. Amit Trivedi, author, speaker, trainer, and blogger with over 26 years of professional experience in capital markets. He is also author of books Riding the Roller Coaster and Personal Finance Lessons from the ICU. Welcome, Mr. Trivedi. And finally, we are also joined by Mr. Vinod Bhatt, who is a senior fund manager and comes with an overall experience of over 2 decades with close to 15 years in the financial markets and investment banking space. Welcome, Mr. Bhatt.
Thanks, Vishal.
All right, so let's get straight into it. My first question is for Mr. Rao. Mr. Rao, our theme today is smart and responsible investing. So my first question to help our viewers understand this better is what these two terms mean, smart and responsible investing.
It's great to connect with you, Vishal, and it's great to be part of a eminent panel with Amit ji and Vinod ji. And from Aditya Birla, I take this opportunity to wish all the audience a happy Navaratri time. I mean, which will be of course, it's a World Investor Week as well as Navaratri, which is coming. And this Investor Week is for the whole week we are celebrating. This comes from IOSCO, I mean, International Organization for Securities and security companies, and it's this year the theme is socially are you a smart investor and are you a responsible investor, how you can be a smart investor and how you can be a responsible investor. And the key two messages were, how you can disseminate the information, how an investor can be smart by being more responsible, as you put it rightly in your intro remarks. And second, this is a part of investor education. Its the whole intention is to fostering these learning opportunities so that investor will be making his money very rightly. And when it comes to personal finance, me and Amit, we always used to say the smart investor is the one who got a smart goals. But today the smart is very different connotation, different topic we are talking about. This smart I can coin little differently is the smart. The S stands for sustainability investment. One is it will be sustainable to the nature. I mean the ESG one where Vinod ji will speak more about it. But sustainable investments. Investing in the sustainable part also you are sustained with your investments in the personal finance side. And M comes with the managing the volatility, and A comes with an asset allocation, and R comes is understanding your risk profile right, and the T is your time in the market, not the timing the market. Probably that's the way you can become always a smart investor. And I think we call this as a socially responsible investors 3. And I call it as a smart investor is a responsible investor, SIRI. And since it is a Navaratri time, I can say Siri is a goddess Lakshmi. You are inviting if you are doing the responsible investments, and you put it right. It's not only your money, but you are putting your money more responsibly, where your money will grow appropriately, and it is adding value to the goodness and good companies of the world, not the bad companies of the world. And of course, in the ESG, we can have a deliberations very differently. And smart and responsible should go together.
Right, smart and responsible should go together. But is there a difference between smart investing and responsible investing, or are they both interrelated, connected?
Yeah, probably it is interrelated and it is interconnected. Of course, the smart investment comes on two sides. I mean, when I'm investing my money rightly. And when it comes to an individual, am I responsible for my investments, my money? Am I taking care of it? That's one part of it. But when I'm looking at a globally at an investor level, it is both are how it is interrelated. Is responsible investment is an approach to the investment. It is basically acknowledging the relevance of the ESG and minimizing the risks associated with the ESG, which is environmental, social, and governance factors. And it's a long-term approach. And end of it, you are investing in companies, the individual companies, which is having a good social value. And the smart investing is the way you invest it rightly. It could be, I talked on the two angles. One is on the personal finance angle, second is another angle. Probably I'll let me focus more on the personal finance angle. As a smart investor, we always say your income minus expense is equal to savings. That's the old formula. The right formula is the income minus savings is equal to expenditure. The smart investing is first you save first and invest it right. And here you are investing not only right, but also investing in the right companies and right investment sphere.
Right. Absolutely. I come to Mr. Trivedi. Mr. Trivedi, like Mr. Rao said, investing right in the right companies, and not only from the perspective of the personal finance angle, but a social relevance angle also. But in today's age and time, what is the significance of being smart and responsible about investing? Are there any benefits to it apart from basically contributing to the society? Does it actually make a difference? Why should one do it?
It's a brilliant question, and it actually reminded me of a book by the title "No Man is an Island" by John Donne. We are all connected, and to that extent, if I only think about myself, then eventually it becomes a win-lose proposition. Sustainable investing is about win-win. So I win and the society wins. I contribute to the society, betterment of the society. And that's really a broader philosophical angle to the whole thing. But having said that, in last few years, we've seen some of the businesses where either the environment was polluted, trees were cut, or some of the other damages were done to the nature. That is something that we are paying the price for. And we as a human race, we are realizing that this is not sustainable. And to that extent, I mean, the word sustainable, I'm just bringing it to the discussion. Apart from that, the companies which are socially responsible in terms of their governance, their behavior, we've also seen, and that there's a good amount of data available to showcase that the stocks of these companies have delivered better returns. And Vinodji can actually, elaborate on that further when he answers some of the questions. But what a little I've read and seen, the responsible companies seem to be better investments as well. So to that extent, it is a good idea to embrace the overall approach.
Right. And both Mr. Rao and Mr. Trivedi want Mr. Bhatt to contribute. So I come to Mr. Bhatt. Mr. Bhatt, when we talk about responsible investing, who exactly is it that we are responsible towards, and why this responsibility, Mr. Bhatt?
Right. So that's the key question, Vishal, and I think there are two aspects to it. One is the responsibility towards the society and the world at large, and the other is the responsibility to oneself. And I'll just explain what I mean by that. So essentially, when we invest, typically the key criteria we look at are risk and return, right? So if I want to invest in a stock, typically I will look at what's the risk and what is the return I can expect. And same thing continues forward. Like if you look at a management of a company, when they evaluate a project for investment, they also typically look at the same two criteria, risk and return, right? So that cycle kind of goes forward and everybody just thinks in terms of their risk and return, right? And what happens because of that is sometimes, people end up taking the wrong decision. So if, for example, some company management may invest in a project that is causing a lot of emissions, harming the environment, right? And because of that, they are increasing their profits, right? Or some other company may employ child labor, for example, right, to reduce their expenses, right? So, or some other companies might get involved in some corrupt practices, bribery, and so on, right? So all these can lead to better profits for the company. This can lead to better returns for the investors, but it's very harmful for society, right? So how do we break this chain? Now, what has happened, fortunately, is that globally as well as in India now, companies have become very aware of the expectations from their shareholders, right? So if we as shareholders take a stand that in addition to risk and return, we will include a third criteria, which is the impact on society as part of our investment, that can start bringing about a change. And as you know, any system-wide change takes a long time. It's typically a gradual process, but it has to start, right? So as investors, what we need to see is a risk, a return, as well as the impact on society. And that will lead us to proactively either eliminate some investments or make some investments, right? So eliminating investments means not investing in those companies, like I said, which may be polluting the environment, or which may be harming the community, or which may be indulging some corrupt practices and so on. So that the management of those companies also then has to put some thought into their actions. And on the other side, we can say that, okay, let's invest, for example, in companies that are, developing, for example, renewable energy solutions, right? So that's beneficial for the environment and the community at large. So in this way, our actions can kind of influence the companies that we invest in, so that when they make their investments, they also take the right decisions. So overall, we are working for the benefit of the society. The second aspect, which both Mr. Rao and Mr. Trivedi highlighted, is, at the end of the day, as investors, we also have to be responsible for ourselves. And as part of that, I think asset allocation becomes very important. So typically what we have seen is that, investors get fixated with some particular asset. In India, it has been, for example, real estate or gold, right? Or just keeping money in FDs. Only very few people are investing in equities, for example. And even in that, many investors just get fixated on some, for example, small cap stocks or some sector or so on, right? But we need to keep in mind that asset allocation is very important for reducing the overall volatility of the portfolio and for increasing the chances of getting better risk-adjusted returns. So that involves getting exposure to different asset classes like domestic equity, international equity, fixed income, and gold, in addition to, of course, real estate, which many investors have in their portfolio. So all these aspects we have to be kept in mind, and at the end of the day, we should be responsible both to the society at large and to ourselves.
Right. And responsibility towards both ourselves, our returns, and society at large. I get your point. But is there, a need for a larger awareness? Because most of the investors, when they talk about investing in equities particularly, they think about only one aspect, that is the returns that they get from their investment, right? So what kind of awareness is needed, and how is that possible, so that people actually, invest responsibly? What would you say to that?
Yes. So typically, what happens is many retail investors don't have the time to do a lot of diligence, right? Typically, they are doing their job or running their business, and they are just investing in equities on the side. And many times they just do it based on, for example, the news that they read or hear or watch on TV, or tips that they receive and so on. So that's kind of becomes a very lazy form of investing, right? So what is required is for investors to put in a bit more effort and do more diligence on the companies that they invest in, right? So what that means is, okay, you need to really, at least go through the annual reports and quarterly reports, see the news in a little bit more detail on the companies to see if there have been any controversies, right? Look at the track record of the company and the management. What kind of investments have they done? Are these harmful to the environment, or are these beneficial, right? Have there been any instances where the management has got involved, either, for example, in corruption, or even, for example, in the composition of their board, or the management compensation and so on? So all these aspects need to be looked at. And unless an investment, you can put a check mark on all the aspects that, okay, this is a good investment, it meets not only my risk and return criteria, but also the criteria for having a positive impact on society, investors should not invest in those companies. So at the end of the day, the key point is investors need to do a little bit more diligence than what they normally do while investing in equities.
Right, absolutely. I come to Mr. Rao, just related to this. Now we know what smart and responsible investing means, but how can one invest smart and responsibly? I mean, where to start? If you are just going to move towards responsible investing, where to start?
Yeah, thanks, Vishal. And of course, Amit and Vinodji already spoke on this, but I can just put it in a. I'll summarize what both of them spoke on this. How you need to be a smart and responsible. Probably investing smartly is to understand why we are investing and where we are investing. That's a differentiation we can look at. If you're only investing for returns, as you put a question, and you invest anywhere and you are getting the return, that is not the responsible way of investing. And you need to understand why you are investing and what is the goal. Probably, and it is also earlier, Vinodji was talking about aligning for the self, and when you are investing and working on a sustainability finance for the self and society at large. And here we will talk about society, self. When your self means you are focusing on your goals and you are aligning your investments with your goals. Means, I am investing according to my goals, my understandings. And earlier, Ji also spoke about asset allocation. And here, understanding asset allocation is like no asset class can always give a superior return. And why right asset allocation, you are ensuring that you are minimizing the risk and optimizing the returns. And here, one need to focus on understanding those basics. Probably, I sincerely thank Outlook Money for all that helping the investors to understand those basics, upgrading those learning skills, and changing their outlook on the money and the way they manage the money. And this is where in our webinar series for the last 18 months, I think we are continuing every month. This is where helping the investors to upgrade their skills. And in the process, they will be managing their investments well, and the investment management is becoming right. That is, I look at as a smart investment. And here, one need to understand the risks associated, probably the importance of the power of compounding, importance of the diversification. All this comes as a smart and both responsible. But when it comes to a corporate and social things, the responsible investments, earlier, as Vinodji said it, it's how you're, you are acknowledging the relevance of the ESG and how the socially committed, is there, are these companies adding value to the society at large or demeaning the society? They are, how they can be punished. You are encouraging those companies which are doing well and where you are investing so that you are propagating the right way. In fact, I do these sessions in some of these management colleges, the sessions on ethics, and we take some case studies where the companies like Enron, how they have lost just because the profit is the, you put the profit before everything. I mean, how you can balance it, profit is not the criteria, but how you can socially responsible. Means you are investing in the socially responsible companies. And here, the great part is it is creating the extra risk protection to the investor. And earlier you asked the question is to Vinodji, how we can propagate incidentally across the globe. ESG has picked up, and post-pandemic, people have understood, right? It is not only me living in the world, I need to make everyone live the better way so that I do live. And if you are at risk, I am also at risk. I think this is what we have understood very well. And the climate change which is happening because of the irresponsible way of doing things, and this is where social investment is coming. And today, corporate India too got enough success stories under ESG, and my ESG, the G part, the management part, has taken a big clue. And thanks to the regulator, who is also part of today the World Investor Week, who is propagating for us. I mean, empowering investor as well as ensuring it is properly regulated and is, having the right business models. If you can see the regulator, SEBI, the way the circulars which have come in the last 3 months, I can see on the corporate governance, it's a fantastic impact. And this will also give investor an advantages. You will be getting a good risk adjusted returns. Earlier, I do not even know the risk where I am investing if the corporate, if the governance is not proper. And and this is where even in India, when it comes to the mutual funds, investors got a way to invest it through the ESGs. I think various fund houses already there to give this opportunity to the investors to look the ESG way of investing.
Right. Thank you so much for your elaborate response. I come to Mr. Bhatt. We are talking about responsible investing. I want to ask you, can investing responsibly actually make a difference in the society, especially when it comes to small investors? How should small investors approach responsible investing? What steps they can take to make an impact in the society through investing? Mr. Bhatt.
Right. Yeah. So as we were talking, see, this is a kind of a system-wide change, right? Change in the mentality of a large mass of investors. So that's going to be gradual, but it has to start. Now, fortunately, if you look at the different stakeholders in the markets, right, we have not only the small investors, but also the large institutions. And the large institutions have already taken some steps where they focus on these aspects. So in the West, for example, we see institutions like BlackRock and other large institutions. They have become more active. They suggest to the management changes that they can make in terms of improving their impact on the environment and on society, right? So small investors can look at what some of these institutions are focusing on, what criteria they are using when they make their investments, right? Now, that's just the first step. The second step, like I mentioned earlier, whatever investments we make, they need to fit both our risk return parameters as well as our ethical guidelines in terms of what we think will be beneficial to society or not. Right? And there is where one needs to put in more time and effort. And first of all, develop a proper checklist for oneself. And there are many sources available where one can see, like, in terms of what are, if we think of impact on the environment, what are some of the criteria to look at, right? So, for example, we look at, okay, is the company emitting a lot of carbon emissions? Is there, a lot of wastewater that is being discharged into the rivers and so on, right? Or if you look at impact on society or the community, for example, are the labor relations for the company good, right? Or have there been any controversies? How is the relations with the community at large? Is the gender diversity being maintained, right? The third is a corporate governance aspect, like I mentioned. So there you have various issues now, like, data privacy has become an issue. The composition of management, the board of directors, that is important. Whether the company has been involved in any corruption charges earlier, right? So what investors need to do is develop a checklist for themselves. And it doesn't need to be a complicated checklist, but basically just 10 or 12 items that they can quickly run through and satisfy themselves that, yes, whatever investment I'm going to make, it satisfies these criteria, right? And the point is that if every investor starts doing that, then we put in cycle into motion where if investors don't invest in a particular company because of concerns, then that signal goes to the management. And the management is then forced to change their ways of working, right? So that is how the power of the small investors come to the picture. Because even today, right, if we look at the proportion of the investments held by the small investors, I mean, you'll be surprised, almost like 15% plus of the free float equities is held by small investors, right? So if they raise their voice, if they send a signal to management, then it will be heard, right? So all the small investors need to think like one, develop this checklist, and then ensure that they follow the checklist when they make their investment. Now, the other option, of course, is, we understand that, small investors don't have maybe the time to do all this. So then, like Rao sir was saying, the mutual fund industry has come up with products which makes it simple for investors to get exposure to equities and at the same time ensure that it meets the criteria, right? So, for example, there are ESG funds that the investors can invest in, which already take care of all this work. They filter companies based on ESG criteria, and hence it becomes easier for investors to take their decisions. The other aspect, like I mentioned, there are also many asset allocation funds. So the investors can invest in those asset allocation funds, and they get a proper diversification across different asset classes. So they don't need to put in that effort also. So these avenues are there. Investors just need to become aware of these avenues and use them to their advantage.
Right. You talked about investing in companies which we get to know, okay, these are not emitting any too much carbon emissions or not polluting the rivers. But how much PR management comes into with what magnitude PR management comes into the picture, because some companies may appear to be responsible, but that may just be management of public relations and their marketing, and they may appear to be responsible, but they may actually not be. So what can investors do to figure out whether the company is actually responsible or it just appears to be so?
Right, exactly. So as investors, we should never rely on one data point or one source for our data and analysis, right? That's a rule we follow. So, for example, we talk not only to the company management, but to various stakeholders. So it may be, for example, industry experts, consultants, research analysts, right? And the suppliers of the company, customers, and so on, right? And based on that, we try to form a all-round perspective on the company, right? So if someone wants to be a good investor, right, then they need to put in that effort to get the data and information from different sources and put together the complete picture for themselves, right? That's why investing takes effort, because you can't just, for example, just read the annual report or listen to an interview of the company management and decide based on that, right? And that's where the differentiation comes in between a good investor and a bad investor. But that also needs a lot of time and effort. And that's why I was mentioning that the mutual fund industry has made it simple for investors, where we do a lot of all this work where we talk to the company management, we go through all the reports, we talk to the different stakeholders, and we do the filtering and choose the best companies to be included in the portfolio. So there are two aspects. First of all, the first step is to eliminate the companies that don't meet our criteria, right? And the second step is then to include the companies that meet the criteria. So all this effort is already being done by the mutual fund industry. There are different funds that are available. So if investors have time and want to put in the effort, they can do it themselves. Else, they can invest in, for example, the funds being offered by the industry and make their life simple.
Okay, thank you so much. Now moving from responsible investing to smart investing, I asked Mr. Trivedi, what are some smart strategies one can use to make most of their investments?
So, Vish, to my mind, for a majority of small investors, retail investors, or let me not use the smaller retail alone, even large size portfolios also, where the person is busy in some profession and investing is only a complementary activity to the main profession of earning money. And which mean roughly 90% of the population. For them, the smartest thing is to keep it simple. Investments carry risks, and we need to understand and manage those risks. But in order to understand and manage those risks, we need to understand those risks very well. Now, some of the points that Mr. Bhatt was mentioning are profound, and this is where a lot of insights must be taken by the investors. Take, for example, don't depend on a single source of information. Cross-check from multiple sources, and multiple sources would mean you'd often get contrary views from different sources, and from that you arrive at your own perspective about what you should do, what action you should do, or what action you should avoid. Now, picking up a stock or avoiding a stock both require this kind of an approach. I mean, it's error of omission and error of commission. Both we have to safeguard us against. So that's one. So if we were to understand the risk, we need to devote that much time. If we can't do it, keep it simple. And that simple is smart. Simple means I'll be able to understand where come in. Part one. Part two, go back to the purpose of investing. Why am I investing my money? I have certain financial goals to achieve in life. I need money for certain purposes. Have I defined my goals? Have I defined those purposes? That's step number two in SMART. So first, keep it simple. Second, identify my goals. And third, align all my investments in order to pursue those goals. I think that, according to me, is the basic framework for smart investing. And the moment you've done that, you are responsible towards your own family's needs. And that is the other side of responsible investing, which Mr. Bhatt initially mentioned, that one is responsible towards the society, the second is responsible towards your own family as well.
Right. And talking about smart investing, there is one more aspect that I would like to ask you about. There is a lot of debate among investors about growth versus value stocks. So what is a smart way to go when you are choosing between growth and value stocks?
Well, it's an old debate, and I think it'll continue in future as well. There are very strong advocates of both the styles of investing. There are some very powerful growth investors, and there are some very powerful value investors, and there are there's a class of very successful investors who say that investing is only value investing, because if there is no value, you will not buy it. Somebody says, I don't really care about whether it is growth or value, so long as I'm buying good companies. So that debate will continue. I think somewhere one needs to find one's comfort. If I am comfortable with the growth style of investing, so be it. If I'm comfortable with the value style of investing, so be it, stick to it. Or if I don't really bother about classifying those styles, just manage the portfolio in that manner. That's how I would put it. I mean, rather than getting into the broad generalization that value would outshine growth or growth would outshine value, I will put it that way.
All right. Thank you so much. Now, talking about smart investing, there is no way we can talk about smart investing without talking about investing digitally in today's time. So I will come to Mr. Rao. Mr. Rao, a lot of investment these days happens through digital channels. While this is true for new investments, of course, like cryptos and other such modern investments, but traditional investments are also being done digitally these days, including stocks and gold, right? So how do you look at this whole phenomena? Is it smart?
Yeah, I look at like this, Vishal. It's a fantastic question. I mean, in fact, me and Amit, we were debating on this some time back. We were discussing on the digital way of investing. Digital way of investing has given a lot of convenience to us. I mean, it has given an ease of investing, but investing smart is still available with you. I mean, whether you use the digital or non-digital, you need to be a smart investor. And ease of investing doesn't mean that you do whichever the way you want it. You need to protect yourself, the first part. And this digital way, I also look at today the digital currencies. People, I mean, every webinar we look at, people will ask about, shall I put it in crypto? I remember a year back when we were doing a session with you, the asset class people were talking about at the time of gold. And always people look at even what gives me the recent returns. It's not the digital way. One need to protect yourself. And I'm not against somebody is investing in crypto or anything, but before investing, you embrace, you understand, then understand before embracing something. That's what I look at. And the second part is on these online investments. When you are doing, recognize those red signs which are coming to you. I mean, why are you investing and what are the things? And last few days I was reading about some of these investors who lost the money, who have not kept the control of their passwords, and how it can be done. Even as of yesterday, I mean, it has happened. I have got a series of messages. It's one of the public sector bank which I had. Your KYC is not updated. Imagine if this has gone to my father-in-law too, and he's a retired civil servant. And he was looking at, हमारा KYC किया था, क्या हो गया? You have not. I mean, last year I went and did it his KYC. He couldn't go to the bank during the pandemic, and I did for him. And he came back and asking me, you have not done last time. You see the message has come. I said, please don't click that link. And it is a dangerous part. It is why this happens. One you need to understand this the prevention of those digital issues which are happening. And in fact, one of the messages from the World Investor Week this time is IOSCO has very clearly mentioned about what kind of cares you need to take about when you are investing with the digital investing, and what are the risks associated with the digital investing. As I said earlier, digital way of investing should be an ease of investing that does not that is not preventing you taking all other cares which you need to take care. And at the same time, earlier sessions we were talking about, please do keep a physical copy for your own comfort of all your investments, because any day, like yesterday night, there is all the services of the social media got out, and then the situation is very, very bad for the people, like what to do next. And similarly, I was traveling a week back. It's a down south, and suddenly there is no internet connection, and even I couldn't pay through my GPay or whichever the way I want to pay it. Means again I need to I need to adjust my risk in such a way. I need to carry some physical cash. That's what I understood at the time, and digital is only an interface. And this interface may be a fast interface, but ensure it is not only fast, it is also a secure. And the recent guidelines on the regulator, when you can see, I think it is going to change the way our pool accounts we handle, and things we are changing. And all said and done, safety should be the priority. Digital should give the ease, and that should not take you out from taking necessary precautions.
Right, absolutely. And like you mentioned, the frauds that can happen on digital media when you are transacting in actual money through digital channels. So, Mr. Trivedi, I would come to you. What are some of the other risks of digital environment, and how can one overcome them? Also, what steps investors should take to ensure that their money is protected when they invest in the digital environment?
This is taking forward from what Mr. Rao was mentioning, and it was a very nice discussion when we were talking on phone the other day. There are two aspects that when it comes to digital, two aspects come to mind. One is safety, and second is ease of transacting or convenience. Now, what should the investor give priority to? Convenience or safety? Actually, they need both. But convenience cannot come at the cost of safety. safety may come at the cost of convenience. I mean, investment, as we keep talking about investment carrying risks, we keep talking about there are certain other risks involved with investing. For example, in the physical era, when we had the physical share certificates, we had the loss of certificate or mutilated certificate, etc., or forged certificates. Today, we worry about hacking of the accounts. No, those risks do present themselves. So we need to be careful about when you deal with any platform, the platform better be secured. And there are certain protocols that the IT industry has specified for that the encryption or the secured payment gateways if you are making any payments, etc., etc. Number one. Number two. When it comes to safety, digital offers a phenomenal benefit if all your accounts, be it your investment accounts, mutual funds, stockbroking, etc., be your fixed deposits or your bank accounts or your demat accounts, link the accounts to your mobile number and insist on SMS whenever there is a transaction. I'll give you an example. Recently, the friend's father, and he's around close to 80 years old. He got an SMS in the morning that your redemption in this XYZ fund is processed. And he got shocked. He said, I never gave a redemption. So he got in touch with the mutual fund distributor and said, what happened? The mutual fund distributor was also quick to come into action, and they could stop the transaction because they went to the fund house, they checked the digital footage of somebody coming into the office, and when they saw nobody had, this person had not come, they verified and they stopped the redemption. Fortunately, the money may not have got anywhere because the bank account was also linked. But I'm just giving an example that a sort of fraudulent transaction could be stopped because of the same digital technology giving an alert and the person springing to action immediately. So digital can be used for safety as well. So that's the second part of it. Third, when you receive any link for any payment, be doubly sure to verify that the link belongs to an authentic and regulated entity without debiting your account before debiting your account. So that's another mechanism that one needs to do any transaction for that matter. So that's number four. Banking system has always said that you don't share your password or PIN with anybody and everybody and just keep it secret. So that goes without saying. But finally, going back to what Mr. Rao was mentioning, there's a beautiful trend that somebody had highlighted that 40 years back, the investors' investment horizon used to be in decades. Then it turned into years, then it turned into months, then it turned into days, and now there's intraday. It is largely the technology which has enabled these kind of transactions. Does it mean that your investment horizon need to become shorter just because there is ease of transaction? All of us know that equity investing is more buy and hold most of the times, unless you are making a mistake and you need to correct the mistake. But if buy and hold is the strategy, then you don't need the convenience of transacting. What leads to the frequent transactions is also the frequent information that you keep getting. And a lot of times it is difficult to separate noise from the news. And in such case, it is the noise which leads to multiple transactions. And the more number of transactions that one makes, the higher are the chances of errors. At the same time, there is a very high probability that there will be costs associated, which would bring down the investment returns. So that also is something that we need to keep in mind. Use digital's power for our own benefit. Don't become a victim of the power of the digital.
Right, absolutely. And digital has allowed us to do so many things that were not possible before. But yes, we need to be careful. Also, we are celebrating World Investor Week. So, I would like to ask one question about investing in global stocks. So I asked Mr. Butt, investing in global corporate giants like Amazon, Google, and Facebook. They're not listed in Indian exchanges. Is it a good idea in investing in them?
Right. Yeah. So as I mentioned before, see, asset allocation is very important, and that means that an investor should diversify across domestic equity, international equity, fixed income, and gold. So international equity should find a place in the investor's portfolio, and there are multiple reasons for that. So one is, it gives economic diversification. So you are not just dependent on how the Indian economy does, but you get exposure to, for example, how the US, European, or the Chinese or the Asian economy does. Second is you get exposure to geographic diversification. So every country has its own strengths and weaknesses. Like, US is very strong in advanced technology. China is very good in mass manufacturing. Europe is very good in advanced manufacturing and so on, right? So we need to get this kind of exposure in our portfolio. And the third and the most important point is, investing in international stocks gives us access to themes that are not available in India. So for example, if you look at the digital theme, right, there are various segments in that, like whether it's e-commerce, artificial intelligence and machine learning, robotics and automation, and now cryptocurrencies and so on, right? These themes are not available in India. Even, for example, the renewable energy themes, whether it's electric vehicles and other segments, right? These are still not available in India. So if we want exposure to these themes, it's essential for us to invest in the international stocks. Now, the only issue there is, if investors don't have time to study Indian stocks, it will be much more difficult to study international stocks, right? So that's why we recommend that one is keep international stocks maximum to 10 to 15% of the portfolio, and preferably invest through for funds or fund of funds. So for example, at Aditya Birla AMC, we have two fund of funds which give exposure to different kinds of companies. So one gives exposure to the well-known brands, established companies globally, and the other gives access to themes that are not available in India, like I was mentioning. So investors can look at these two fund of funds, for example. Or we also have an international fund which directly invests in international stocks. So the idea is to make it simple for investors to get exposure to these international stocks, while at the same time not requiring them to put in a lot of effort to do so.
Right. And are there any risks involved when it comes to investing in international stocks?
Yeah, definitely. So, there are a lot of macro aspects that impact all stocks. So, for example, if you look at what's happening in the US, right, the US Fed can come out and say that, okay, they are going to start tapering, for example, in November. Or, for example, depending on how the supply chains are functioning in the US, inflation can go up, right? So when that happens, for example, the yields in the US or the interest rates start going up, and that can affect, for example, technology stocks valuations, right? So all these aspects are there which have to be kept in mind. And at our fund, for example, we have a team of analysts keeps tracks of all these data points, and based on that, we make changes to our portfolio. If you talk of individual like retail investors, it may be much more difficult for them to keep track of all these aspects, and that's why I said that there is definitely some amount of risk involved, and it's better to invest in some fund of funds.
Right. Thank you so much. Before we conclude, I would like all of you to give one final message on World Investors Week to our viewers. We can start with Mr. Rao.
Thanks, Vishal. I mean, indeed, it's a good seminar to put all those questions. I always say you are the best to extract from everyone. And this is the World Investors Week on the smart and responsible investment. I can only say be a smart investor and be a responsible investor. A week back, we were in Tirupati with all my colleagues at Aditya Birla. And there are two signboards which were catching my attention when it is more relevant for the World Investor Week. One side I have seen Dharmo Rakshita Rakshitaha, and second side I have seen Vruksho Rakshita Rakshitaha. That is, you protect the dharma, that's culture, I mean values, then it will protect you. Similarly, you protect the trees will protect you. Similarly, when it comes to investment, it's doing good for the world can do good for you. Invest in those companies socially responsible, then you become very responsible for it. And it will also do good for you because it is minimizing your risks. And that's where I look at and the last is the being a smart investor is mutual funds makes you very smart investor with a simple way. My SIP, I call it is a smart investing plan, smart investment in practice, and do that. And I mean, I just take this opportunity to wish all the audience a happy Navratri, and be a socially responsible investor and be societally responsible. And Of course, it is your investment. Ensure that you get enough returns by investing appropriately and rightly. Of course, last is don't forget to have an advisor for you, because that's the most responsible way. Some coach is always good for you.
Right. Thank you, Mr. Trivedi.
I'll just say something which is not covered in the discussion so far. Responsible investing, or ESG, is also called impact investing. So in one way, you can make impact in the society through carefully choosing companies which are responsible. But at the same time, there's another responsibility that all of us have, and just being a World Investor Week as well as Navratri, on this auspicious occasion, I would add that at some point in time, some of our investments may also be used to go towards charitable causes, and that also is a huge impact to society. I mean, that's where I would end. And may Goddess Durga, Lakshmi, Saraswati, all the goddesses bless you on this occasion of Navratri.
Thank you, Mr. Bhatt.
Yeah. So my recommendation is that investors, instead of thinking how much profit a business is making, change that question to how is the business making its profit, to take into account the environmental impact, societal impact, and the corporate governance impact, right? And to keep their life simple in that sense, maybe think of investing in the ESG funds. And as part of being responsible to themselves, again, instead of asking a question, how much return am I making, change it to how I am making that return. So is it sustainable, right? And the solution for that is to invest in, for example, asset allocation funds. So these are the two kind of questions I would like investors to think about.
Right. Very well said. And on that note, we conclude today's session. I hope you all had a great session and learned a lot about smart investing and responsible investing. And I hope all our viewers would be more responsible towards how they invest in future. And on that note, we bid you adieu. Wish you all a very happy Navratri and World Investors Week. See you all next time. Till then, have a good day. Bye-bye.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.